Hi, everybody. My name is Ola Ibiwoye. Once again, I'm joining you here from our studio, Commercial Property Club podcast. We are here live and practically normally what we normally do is also share knowledge base when it comes to income producing property, class asset apartments, retail warehouse, senior living, and also medical building. We bring on board expert professionals, deal maker, deal flow prompters, also too in the industry, people that can bring on board valuable knowledge that is going to be of great value out there for people that are trying to get into the business and also people that are already in the business. For investors alike, we believe that knowledge, you're able to invest better. So Commercial Property Club is a platform for you guys to listen and also gain knowledge as regards to income producing property. Today is a wonderful day. I have a great friend here, somebody that has done it, is still doing it, somebody that has really done so well in the Texas area and also to, I believe, outside the auspices of Texas, also too, an investor, a builder, also too, by trade, also too in the apartment space. His name is Venkat Avasarala. Venkat Avasarala is the principal and founder of Stryker Property. He's done so many things in the Dallas area, also too. They were founded in the year 2016. Stryker has substantially grown its portfolio in high growth Sunbelt market areas such as the Dallas area, the Austin area, Phoenix, as well as the Denver area also too. And what they practically do in being the CEO and the founder leads the team out there. What they do is bring investment opportunity to investors. The accredited side of things, actually busy professionals also to have a niche with them whereby they can do much with their funds other than channel it through the portals of Stryker Properties, and they can invest for them wisely. I'm going to say a little bit about Venkat before I bring him on board. He's done so many things, started with the aspect of valued apartment sector. Right now, is scale things up, developing 200 to 500 unit class A market apartment community in the DFW area, the Austin area, as well as the Phoenix Metroplex. Venkat has really done so much in the apartment sector. Without no further delay, I would love to bring Venkat on board so that he can share valuable knowledge. Today we'll be talking about how to scale up syndicating of apartment building, how to scale it up. And he's going to be sharing with us how to do that today. So Venkat, welcome to Commercial Property Club podcast. Thank you for joining us today.
Hey, thanks for having me, Ola.
Yes. Thank you so much. It's so good to see you again. You know, you and I were just talking about the last time we were bumped into each other in Brother Sumrock's event. Yeah. So today, let's start and see how it all started, you know, and if you want to just, I'll just have you speak about yourself. Who is Venkat?
Yeah, well, I'm originally from India. I came to United States back in 2002 to pursue my master's degree. So I completed my master's in electrical engineering. Didn't end up finding any job in electrical engineering, so I ended up in IT. So spent 14 years in corporate IT, worked at places like ADP, Halliburton, PepsiCo. Last gig was with Bank of America. So around 2007 period is when I started real estate investing. Before that, I used to do stocks and just quickly figured out it's not for me. So I moved to real estate in 2007 and started with single family homes, bought about 20 of them, just my personal portfolio. And back in those days, on day one, they were cash flowing like 15%. If it doesn't cash flow 15% on day one, I wouldn't even write an offer for it. So we were spoiled back then.
Okay.
So that went on for like until, let's say, mid 2015s or so. And then I'm not getting those 15%. I mean, I'm only getting 10% at the time. So I was like, no, I'm not going to do this no more. I mean, right now, people would kill for something like a 10 or even an 8 or even a 6% return.
Okay.
So back then we were spoiled. So I thought that, okay, single family was over. So I wanted to scale and started doing commercial real estate in 2016. And bought, since I live in Dallas, I was just started this as a side gig and ended up, leaving my job in 2018, just 2 years into the commercial real estate. Okay. So I bought and sold about 3,000 units. I still have about 3,100 units, actually. Sold 3,100 units, mostly in DFW. But some in Denver, some in Phoenix, and I still have about 400 units value add left in Denver and Phoenix. Okay. But about 3 years back, I took a hard pivot from value add to ground up construction on multifamily. Okay. Mostly in the DFW area, but I have some projects in Austin and some in Phoenix as well. So about 2,500 units in pipeline, about $700 million in pipeline. So mostly that is where my focus is. I do a fair bit of land development as well, where I buy raw land, well-located raw land on highways, state highways or national highways, and try to zone them and sell parcels. Okay. So those are the two things I'm mainly focused, but ground-up construction, multifamily, Class A multifamily market. Okay.
Oh, wow. Wow. Talk about growth from corporate America to seasoned entrepreneur when it comes to income producing property. And you started small with single family, and you developed that into syndication apartments, and subsequently you're now developing, and quite interesting. And today I would start with the syndicating aspect of things, that gradually will go down to the development aspect of things. Take us through how you would syndicate a deal. An apartment deal.
Yeah. So the good thing about like syndicating an apartment is like you are not personally limited by your own personal financials or your personal net worth. So you can buy a bigger apartment complex and scale with it, right? So it's about leveraging the resources for the betterment of yourself and for your investors also. Yeah. Because a lot of people, I wouldn't say they're unlucky and unlucky or the vice versa. But so many people are just happy with just doing their 9 to 5, right? I mean, it's not for everybody because running a business is a lot of headache. You're taking a lot of personal risk and you have the weight of the responsibility on your shoulders. So it's not for everybody, right? But a lot of people who I worked with, my friends, my family, and then several people I met in conferences and all that, they invest with me. They all have 9 to 5. But look, I'm able to make a small change in their life where I can grow their equity. So that is fulfilling as well, right? Yeah. So coming to your question on exactly how you go about syndicating, I would say start small, but not too small. But don't go for a 20 unit or a 30 unit or 40 unit because you will not be able to afford a property management company. There's just not enough revenue for you to be able to. And you need to bring in order for you to scale and do a good job, you need somebody whose day job is to babysit the property on a daily basis. And that's our professional management. So I would recommend doing, that's what I started. My first property was exactly 100 units, a C-class property. At the time, I bought it for $35,000 a door and sold it in 2-3 years from that for a nice profit. But yeah, I only needed $1.2 million. I'm saying now I only needed, but at that time I was like scared. Like, oh my God, I got to raise 1.2 million. I never raised $1 in my life. I just did all my deals with my own money. So that is where you partner with somebody who have done that before, right? I mean, if this is your very first deal, there is no replacement for experience, right? I mean, you just don't know what you don't know. Yeah. And especially when you're taking other people's money, you need to have experience yourself. If you have all the experience that you need, that's awesome. But if you don't have to stop there. You need to bring that experience onto the team, right? By bringing a co-GP. And that's exactly what I did, right? So I brought somebody who have done like a half a dozen deals by that time. so that I do all the work, but under their supervision, right? So that we are good stewards of investors' money. Of course, we'll share the compensation and all that, but nobody's trying to get rich off the first deal, second deal, third deal, or even 10th deal, right? I mean, it's a process. It's a process.
Yeah, it is a process. Yeah.
That is exactly what I did. I brought in somebody. I worked with somebody who have done at least half a dozen deals, and that was my first deal. We together raised one. I did all the work, but under the supervision of an experienced GP. And then second deal becomes that much more easier. Third deal much more easier. And especially as you building up your resume, right? I mean, the brokers who are actually our brokers, right? I mean, they award the deal to you. They're going to comfortable with you. Hey, look, this guy, he means what he say. When he signs on a dotted line, he means he's going to live by that. He'll be able to raise money, and he'll be able to arrange a loan, and he's going to close it. Make me good in front, make me look good in front of the seller. That's all they're looking for, right? Once you give that confidence to them, they will call you with deals. And that is how I scale, basically.
Wow. So invariably you needed experience to come on board. And all through the process also you needed somebody to vet you so that subsequently that deal flow too could be there and subsequently rolling back in, when you opt for your next deal. Wow, valuable nuggets right there that that would help a lot of people out there.
I would add is very crucial, right? See, I've been living in Dallas since 2006, so this is my home, right? I mean, I'm coming about 18, 19 years now. So I've been searching for my first project in 2016. Took me 6 months, 8 months. Nobody would award me a deal. They want to. It's just that my resume is empty. That's why they cannot trust me with the deal in DFW, which is a very hot market. At the time, people were even questioning the need for the broker. Why would we need a broker when the market is so hot and I'm getting so many unsolicited offers? I'll just pick this one and give it to him and save myself commission, right? I mean, that people were questioning the need for brokers back then. So in that climate, no broker would take a risk on me when I don't have a resume. And if I don't close, guess what? He's going to lose that commission, and that the property will go to somebody else, right? That's the matter. So I decided that, it's not going to work out for me here. So I stepped outside my market, and I bought my very first property in a town called Norman, Oklahoma. It's a college town right on the main street, 100 units, classy property, 35 a door. Right. So it's just like a training wheels kind of thing. Right. So I got, and there people were not very choosy when they were awarding deals. Norman, Oklahoma is a lot of notches down when you compare to Dallas, Texas. Right. So, and then I proved myself, and that's all it needed. My second project was 120 units in Phoenix, proper Phoenix. And then 306 units in Mesquite, Texas, like a proper DFW. Right. They just need an evidence. They just need to see the evidence that you can
do what you say you would do. Yeah.
And then, I came right back into the metros, and ever since I stayed in the metros, I never went out. But the time is of the essence right now, right? At the time. So had I not done that, I would be just spinning my wheels. My LOI would always go to the bottom of the stack because I just didn't have a resume.
Oh, wow. So the aspect of going to a market to prove yourself, to stack up your CV, so that, it's that credibility will be there for brokers to see that, okay, this man can close the deal.
That's it. It's as simple as that.
Yeah, those are valuable experience that you had to go through it to experience it. So what were your best practices when it comes to putting your team together for syndication business? You talked about an experienced hand being on board. What are your best practices?
So it all starts with property manager, right? I mean, you can buy whatever you want, but if you don't bring A game when it comes to property management, it's just not going to work out, right? And now that is true now than 5 years ago. We got it so easy, right? Back then, like I was saying, right? My very first Dallas property, I paid like $50,000 a door. You don't get anything for $50,000 a door in the state of Texas, let alone Dallas or anywhere, right? So back then, we used to, and that was an 8 cap, right? I mean, 8 cap C-class property. So even at 6% interest rates, it's hard to get even a 5 cap or a 6 cap, right? Right now, even with this interest rate so high. So what I would tell to the newbies is be really, really careful with the numbers. Underwriting, you need to master that underwriting, right? It's Excel, right? At the end of the day, it's not rocket science, it's Excel, but you need to be able to relate the day-to-day operations and translate them into Excel and model it, stress test it, and make sure that you got your numbers right. If you don't know those numbers, if you're not good with the numbers, that's totally fine. Just get a co-GP who's good with the numbers, but don't go without one, right? I mean, that's all I say. Do not go without one. So you need to analyze that, 10 ways to Sunday there, and then feel good about the numbers. And then the property management, right? Okay. Work with the property management in the underwriting phase as well. And then if you do not like the property, of course, you take references and all that. But in spite of all these things, 6 months into it, if you feel that you made an error with the property management, just ruthlessly fire them and get somebody else. Because the only people that you should be loyal to is your investors. They give you their hard-earned money. Yeah. You don't owe anything to anybody except for your investors. Yes. Right? You just brutally fire them, bring somebody else, and fix the issue rather than just trying to be nice guy, And I'm saying that because, I did all the mistakes and I learned from them. And that's why, I'm just reiterating what one shouldn't be doing. Yeah. Right? Then the property management, right? And then get a good reporting, right? Again, at the end of the day, if your investors are not playing along with you, not giving you money when you want a deal, you cannot scale as well, right? True. So just keep them updated. Over communication is better, right, than under communication, right? So write a very detailed reports. Do not just forward them whatever property management sent to you, saying that, this is this month's report. No, they don't have time. They're passive investors. That's why they give you the money. So just transmit all that into English and just break it into sections and talk about leasing, we talk about collections, talk about future plans, issues, property taxes, insurance, and all those things so that they can wrap their mind around it. So that is what I would say just for somebody who's getting started, right? I mean, focus on underwriting well, have a good property management, and communicate with everybody, especially your investors. Wow.
So the aspects of property management is make sure that your numbers are good also too on the underwriting aspect of things are very important. And that's those are important aspects of your team to make sure you scale very well. Wow, those are good salient points that you shared with us right now. Thank you for doing that. So in your experience, what makes sense in an apartment deal? What would you say makes when you looked at it, you've underwritten it, you got your deal flow coming to your table, you say, no, this is it, no, this is it, this is it. What makes sense in an apartment deal?
It all starts with market selection, right? So it all starts with market selection. And I say that because Texas, I have seen, like I was saying, right? I mean, single family homes, apartments, let's take apartments, right? Okay. I'm not talking about ancient history, 7 to 8 years back. Mid-2015 is when I started looking at commercial deals. At the time, these apartments, C-class deals used to trade at $30,000 to $40,000. They used to bring in 2% of the purchase price in rent, meaning if you pay $35,000, the rent was $700. Yeah. And the tax assessment was like on 50% on what you paid, property taxes. Insurance was $200 to $250 a door, right? Yeah. So basically your OPEX, operational expense ratio was like 40%. So you bring in $1 rent, 40 cents goes back onto the property. You have 60 cents to pay mortgage and to pay your investor's cash flow. That is how it used to be, right? Now let's see, everything is $100,000. I'm talking about C-class here, right? B is obviously like something like 140, 150, and A is like north of 200, right? Yeah. So even if you take a C-class property, now it's like $100,000, $120,000, and they don't bring 1% rent. They bring maybe 0.7% of the purchase price in monthly rent. Your insurance is like $1,000 a month. Your taxes are fully assessed on the 100% of the value. Yeah. So the business have changed. That is the point I'm trying to make. The business was not static. It just everything changed about it. The price of the apartment, the insurance cost, the taxes, the payroll, everything changed and became a thin margin business, at least in Texas. So that's why, I exited everything. I sold everything in state of Texas in September of 2021. And I still have some properties in Phoenix and Denver. And if a good deal comes along, I'll buy it. But basically, you need to have the margin of error because see, look, only God knows everything and we ain't God, right? So you just have to be, you need to have the humility to agree with yourself that I don't know everything, right? So that's why you need margin of error so that you don't lose people's money. Forget about making the money, but you shouldn't be losing the principal, right?
True.
So that margin of error has erased completely in state of Texas. That's why I left. But not to say that, if I see some good deals again, I'll come back right in. But for now, the market is still, even today, still hard, where it's hard to make sense out of the deals. And that's why I moved into the development game. But just to answer your question, right? So that is what I would say. I would select a market where my OPEX ratio is less and I have full control on it. The complaint I have about Texas is I don't control property taxes. Property taxes make up 50% of my expense bill. I don't control insurance and the weather god, right? Now I used to pay $200 a door and now it's $1,000. And recently heard somebody in Houston, they're paying $2,200 a unit on a C-class property. Heck, even A-class people don't pay that kind of insurance bill. I don't control that, right? So I don't like things that I cannot control, right? And also they make up a huge portion of your expense. So that's why I selected these Phoenix and Denver where the property taxes is minuscule. Your insurance is small. It doesn't go up like they do in the southern states. Okay. So I like states where my OPEX ratio is low, where I bring in $1 and I keep 60, 70, 80 cents on it. And then I pay for the mortgage. I still have money left to distribute to investors. The market selection is definitely number one, right? And the second thing is the vintage of the property. I'm telling you, the weather has changed, whether you call it climate change or whatever it is. The weather has changed. Its natural calamities are much more extreme. You saw the rains in California. You see the flooding that happens in Northeast. And Texas and Florida is open game. We get hit all the time, right? It wasn't like this 10 years back. 20 years back wasn't like that. So you need to buy into places and you need to buy that kind of assets which can withstand this kind of weather, right? Last year in 2021, I had a bunch of properties in Dallas and I got hit by a Texas storm, right? Winter storm, where the temperature was 15 degrees for like a week. We're just not built to sustain that kind of weather, to withstand that kind of weather. And we had pipe breaks and pipe leaks and all that. So look into that, right? Buy a proper vintage. I'm not saying buy brand spanking new one, but you don't go for like 60, 70 properties anymore in certain markets. So watch out for that, right? And go in the property with enough cash cushion, right? Because that capex will happen. It's a certainty, right? Especially with the property less the capex requirement, right? So, and obviously the value add, right? That goes without saying. Make sure that you really have that value add and where you can actually raise the rents. And one other pitfall, I started with 100 units, 150 units and all that. And immediately I went to 50. The quick thing I learned there is when you are comping out, let's say you have a 300 unit property and let's say you have a 400 unit neighbor, maybe 50 unit neighbor. Let's say they're getting $1.50 per rent. Being underwriting $1.50 per rent because that guy is getting $1.50 rent, it's not going to work. He has only 100 units to sell. I have 300 units to sell. I don't have the same pricing power as him. So I got to be at maybe $1.40, maybe $1.35, right? Something less than that guy so that I can actually use it. And I see so many people buy these bigger properties, just underwrite as if they're going to get that market rent on a 100 unit property. And you'll never hit those numbers. And then it's gone.
Wow.
So these are a few things. I know these are assorted items, but these are a few things I would say which will determine a good project versus a bad project.
Wow. Valuable points that you shared there, right there. It's amazing how you have to watch the nickels and dimes when it comes to rent and stuff like that.
Yes.
Oh boy, a valuable experience you've shared with us out there. So what are your best practices when it comes to raising money from investors for your projects? Because you've mentioned a few. You've mentioned how much your investors are valuable. They're the most important.
I haven't advertised. I do 5 or 6 Ds, so you will never see my ad on a Facebook or anywhere, right? I like to do things this way. I want the community I want to know who I'm investing in, right? it's important for me. So, but I still got lucky. I raised around $150 million in the last, since 2016. I raised 42 million just last year. But I always am clear about what I'm doing. Right? Okay. When I moved out of value add into ground up construction, I was able to get my message across to my investors with a crystal clear clarity on why I'm not doing that anymore, why I'm doing this, and what changed. Right? It's all about your ability to articulate. Right? Don't assume anything. They are passive investors. They got other stuff to do. They have their 9-to-5 jobs. Somebody running a business or something, right? I mean, they don't know. They're not keeping up with it, right? So educating your investors on what you're doing and why you're doing, and what are the risks, what are the opportunities, and how you have a trap set for what is your mitigation measures when the risk materializes. These are the kind of things. It's the communication, right? At least my investors, they are highly educated. Most of them have bachelors and masters. And they're from IT, doctors, business owners, and all that, and they can relate to what I'm talking about, right? But and what that means is, first, I have to educate myself.
True.
On any given day, I need to know what's clicking in this country financially, right? How are the interest rates doing? How is the government fiscal policy doing, right? And local politics and everything. This matters. Macro affects you. There's no two ways about it.
Absolutely.
You cannot say, I don't care about it. No. You need to know everything, like artificial intelligence, right? I mean, you learn everything what is going around you, which will help you make better decisions. And when you do all these things, your investors will see through that. Man, this guy knows what he's talking about.
Yeah.
Right? He's thinking for all of us.
True.
I think I'm in good hands, right? So that is what you're going to get. And also, I make it a policy that I don't take money from everybody, from anybody, until they attend my webinar and give me 3 hours of their life, which they'll never get back, right? If they have to spend 3 hours with me on a webinar, go through the Q&A and everything, so that they understand what they're getting, so that they can decide by themselves that is this for me or not. And that has been my way. And I get a lot of word of mouth referrals. I don't do advertising at all. Whenever somebody invites me, like as a guest on their podcast, it's free. I go for it. But other than that, just to get my message across, right? But I don't do advertising and all that. And this has worked for me. So that is what I would say. There is no easy way. I mean, you just need to master your domain and then solve. And you should you should master the way of articulation of what you have learned your investors. So they have to feel it in their gut that, yes, this is the deal I want to be in. We cannot talk anybody into anything. We can just press the opportunity.
Yeah. Interesting. Valuable points. What you talked about, the fact that, being clear with your terms, articulation, and also your personal experience with your investors is quite important, which I can agree less with you that, you just have to be able to have a relationship with the investors that you bring on board, and that's what would help scale your business. So when it comes to the aspect of scaling up, I know you've done syndication very well. You've mastered the art of syndication, and now you find yourself in development. How do you start apartment development? How would you start that?
Gain experience, right? Go get somebody who have done it 100 times before, or at least 20 times, right? So again,
back to what you said earlier.
I went and got myself a partner he's in his mid-60s, and I can go just hire a fee developer, right? Somebody who have done it before. I'll pay them a fee, and then they'll develop. But rather, I went one step forward and make them a part of the team. So I made them my partner, right? So where they sign on the loan, they put up the money. So everywhere they're just intertwined with the deal. They cannot go anywhere, right? Again, you're taking your investors' money. It's not all my money. If it's all my money, my risk-taking potential will just be much higher, right? If it's all my money. But if the day when you're syndicated, you're responsible for other people's hard-earned money. So you cannot take those kind of risks, right? So that's what I did. So I brought in a partner who have built about 9,000 units in Texas, in Dallas and Austin, for a REIT, making my partner. That is how we co-develop these properties. And the philosophy behind this is, there are two Americas right now. One, top 20%, and then the bottom 80%. And the issues are structural in our country, like any other country. It's not US, it's not really, where the income inequality is increasing, right? The top 20% who have college degrees, who have marketable skills, their life is getting better year over year. They make more money than last year. They know how to invest their money and all good stuff, right? If I increase rent on them year over year, $150 or if a class or $200, it's no big deal. They'll say, oh man, what is it? And they'll pay it. Right? It's not like they should stop eating outside or anything like that. They'll just pay you that extra $200 a month, no problem. But I cannot say the same thing about the bottom 80%. And how long we've been hearing that 7 out of 10 Americans are living paycheck to paycheck. Right? What that means is if their car breaks down, your rent ain't getting paid. And that was before COVID. And after COVID, it's much harder with this inflation and all that. So I made a conscious choice which America I want to serve. All these days, I've been serving this bottom 80%. And it served me well and served them well, served my investors well until COVID. But then after COVID, this inflation, right? This inflation, it's a lot of changes that happened to our country where the bottom 80% is struggling. They're struggling. They are paying the brunt of this inflation problem that we're going into, right? So I made a conscious choice that, you know what, I'm going to serve this top 20% of our country. Okay. And otherwise, what will happen is their problems will become my problems and my investors' problems. I don't want that, right? So that's why I just jumped the ship, and now I'm serving these Class A properties, and I'm going to lease them out. I'm going to stabilize them, operate them for a while, and sell it for a profit. Wow. And now I have a higher threshold because now I'm in development game. I'm not sending checks every month like a value add would, a value add property, right? So now no longer is 15-16% is enough for me. I need to generate a better return because I'm asking my investors to wait for 3.5 years so that I can design it, build it, lease it up and stabilize it and sell it, right? But then I'm in Class A areas dealing with Class A tenants who are doing well, especially in metros like Dallas, Phoenix, Austin, right? Those are the people. And also the changing demographics. The single motherhood has exploded in this country, right? And then people are getting married late. And even if they're getting married, they're not everybody's having kids. Even if they're having kids, they're having it late. A lot of changes in the demographics. So all this translates to higher demand for rentals. And also people don't want to do 9 to 5. The high skilled people, they want to do gig economy. They want to be on Fiverr or YouTube videos or whatever. They don't want 9 to 5. And they want that freedom to travel and things like that, right? So not everybody's on a line to buy a single family home, is all I'm saying. So the younger generation, those who are born in 90s, early 2000s and all that, they are driving this apartment demand, right? And I want to build apartments for them so that they can live in. So I only build 1 bedroom and 2 bedroom, very few bedrooms. And some properties I don't build any 3 bedrooms. Because again, we are serving totally a different demographic, a changed America, if you will. 20, 30 years back, this won't work. But today, this is the new reality, right? I mean, this is smaller housing structures and all that. So once you understand that, it will become very clear on what you want, what you have to be doing. You need to build a 300-unit apartment complex in a major metro like DFW, in a wealthy area where people don't mind paying that extra buck. And now in return, you give them nice amenities, right? A resort-style pool, clubhouse, all the good stuff, right? Dog washing stations, EV charging stations, right? All this kind of stuff. And that is where I want to play. And now that has to pay well for my investors because they're waiting for 2 years to get paid.
Awesome. Really, you talked about the generation shift. There's been a lot of generation shift in the products that need to come on the market right now has to be commensurate to the kind of generation that we have right now. True talk. And so what does it take to succeed in apartment development?
It would first of all take somebody with a lot of experience on your team. Again, I'm telling you, you just don't know what you don't know, right? But if you have somebody on your team who has a lot of experience, I'm sure they made all the mistakes in the book and then some, right? I mean, they made a mistake, they learned from it. They lived through 1970s, crazy time, right? I mean, the Vietnam War, hostage situations, 80s crazy inflation, Reagan changing the tax laws, hyperinflation. Then 2000 dot-com bust, 2008 GFC. Well, they survived all this and standing right in front of us to tell us the tales, right?
Yeah.
Let's go work with them, right? They're battle-hardened. So that is the number one thing I would say that is important. And the number two thing is, it's so easy to get carried away in development, right? Because you have a piece of land, open slate, you can build whatever you want on that, right? So again, if you don't have a strategy, if you don't have a time-tested strategy, which is still modern enough to serve the current needs of the country, current needs of the demographic, it will fail, right? It won't get funded, or maybe it will get funded, or maybe you cannot lease it up. All these risks will come into play. So what I would say is just talk to as many as people, talk to your lenders, talk to other developers and all that, and get your knowledge, and have a box and stick to that. Don't waver from that, right? Suddenly you cannot go from 300 unit multifamily to 200 unit senior, because it's different ballgame. It's different demographic. If that is what you want to do, okay, go for it. Don't just do too many things at one point. Specialize in one thing before you try to branch out, is all I'm saying. Stick to the box. If you don't have a box, you will be all over the place.
Wow. Valuable nuggets right there as regards to, being successful in developing an apartment. Wow. And in your travels, in many of your experiences, I would say there are some experiences in which you would say, I've been through this, you don't want to go that route. You talk about bringing on board a lot of experienced hands, which I have no doubt that you have on your team. You've had on your team in the past, even in the present. What would you say that deal, that was an unexpected?
I would say two things.
I would say, that reminds me, I don't want to remember that again. Or you would say that's an unpleasant experience in one of your projects that you would refer to that, I don't want to go that route again, that kind of a thing.
Yes, this is what I would say, right? Number one is not fighting a property management company when I'm supposed to. Keep giving them chances, right? That is a big no-no, right? You just don't have enough runway. You raise money and you do these projects for 3 years, maybe 4 years, maybe 5 years, and you give them 6 months, that's just too much, right? 6 months is a long time. You would know what they're up to, right? You cannot just keep giving chances. And that is, if I can go back in time and redo that, I would do that. This particular management company, they're not up there anymore. They're gone. They're not there anymore. But yeah, that is one thing I would say. And also, don't chase the basis too much. One time I bought a property in South Dallas, $54,000 for a 1984 villa. And I bought it in mid-2018 or late 2018. By the time, there's no such thing as $54K per door for a 1980s product, right? I jumped on it, but the area is sketchy, right? Wow. It's hard. I changed the name of the property. I changed everything about the property, paint the whole thing, new scheme, not everything. But you just cannot change the neighborhood, right? And just because somebody gives you a low basis, just don't go for it. I would say that location trumps the basis and location trumps the vintage.
Wow.
You can deal with, let's say a wall fell down, you can build it again. But if people are shooting each other, you can't do anything with it.
That's true.
Right? Nobody good want to live there anymore.
That's
right?
True. That's true.
So
yeah.
I would say put the market, right? When I say market, I'm talking about income. If the income is high, everybody will act well. That's the way it is. The people have something to lose. They don't want to be shooting each other, right? So they don't want to do crime. They like their life. They make good money. They have something to lose, right? So put market number one, and vintage number two, and the basis number two. Not the other way.
Wow. That's those are great points you shared with us right now, honestly. So, with your vast experience, with all that you've shared with me today, I can't but to say what's your best advice for newbies, people that have coming on board newly?
Yeah. So again, I see a lot of newbies saying that, look, it was easy for you, but now it's so hard. Everything is high in prices. I get it. Totally. I get it. So, but then again, there's opportunities also, right? There's so many opportunities. I mean, money raising was not that as easy right now as it was 10, 15 years ago. There was no meetup.com. Now you throw in a meetup or Eventbrite or something, and suddenly you can assemble 100 people. Now you have a Facebook group, suddenly you can reach out to so many people and influence. So you can do a webinar and this many people comes in. It's in several ways, the technology and everything makes things a lot easier right now. But, and also information very easily available. So you have Facebook, you have LinkedIn, you have this, you have that, a podcast, for free, you get so much knowledge also. In several ways, it's better, but you just have to do your due diligence and your homework a lot more before you pull the trigger on these things. But what I would say is, one thing is, please do not go for easy stuff. If it's easy, there's no margin in it because everybody else is doing it. Please go for hard stuff, right? Heck, I would even go on to say that, try to develop something in California, right? I mean, because it's hard. Not many people do it. Maybe instead of 10 projects, you'll be able to develop only 2 projects, but you have a lot of margin for you and for your investors. That is something I have learned a hard way. And that is what I've been doing, right? I mean, I'm practicing what I was saying. I started with single family, a lot of margin, then the margin goes away because everybody's buying them. And now the prices go up, rents are not keeping up. I got out of it. And then I did value add. Okay, now everybody's doing that. I got out of it. And now I'm doing development, which is much more harder. So you have better margins. And if the day comes where everybody's doing it and the margin's shrinking, I'm out of that. I'm going to go do something else. So be very flexible with your mind and chase the spread, the margin. The better margin you have, the more resilient your business will be when something like COVID comes around or something like those high interest rates. But if your margin on a 5% thin margin, it can swing to a big loss in no time when something unexpected happens. So margin is everything.
That's very, very valuable what you talked about, right, in terms of margin. And that would take me to the last question that will cap our show for today. These are times of rate hikes and inflation. I mean, we mentioned it a little bit during our conversation. So rate hikes, inflation, what's your best advice for investors right now?
Look, if there is a good project that you can buy for a good basis, now what is a good project? Good location and all that, right? Let's take North Dallas. Again, I live in Dallas, so it's easy for me to give examples in Dallas. Okay. So let's say North Dallas, Richardson, Plano, Collin County, anywhere Denton County and all that. An asset which is like late 80s, early 90s and up. And if you can find it for a good basis, like let's say 150, 160 per door, but 6 months ago, 1 year back, it was those kind of properties are trading for 180, 190 and all that, right? Okay. So where you can go and add value, right? So this is not so old that a high-skilled person won't live. This is new enough property where I can make it shine, right? Okay. So you can step in there, and then if you have some patient equity, this is the right time to buy those kind of properties and just sit on them, and they don't pay a whole lot and all that. But when the interest rates come down, and they will, and they will. And the reason I say that is the biggest debtor in this country is the government itself. They have $33 trillion debt. You and I have what? Nothing, right? And they cannot pay these high the interest rates because their debt service in 2021 was $300 billion on a $4 trillion budget, less than 10%, maybe 8-9%. And this year it's projected to be almost $1 trillion on a $4.5 trillion budget. So now it's more like 20%, right? Yeah. So it's just not sustainable where you're just collecting so much taxes just to service the debt. So from that standpoint also, this interest rates will go down. They have to. I don't think they'll go back to zero like crazy 0% and then 2% interest rates in 2021. But I see 10-year at 2.5%. And I see so for less than 2.5%, maybe like a 2%, and I just leave it there for a while. So interest rates will go down, and then you can actually take an arbitrage and sell it. But you should be alive until that happens, right? So obviously don't buy inverse, like don't pay a cap rate, which is lower than your interest rate. Then it's a negative leverage. I see a lot of stuff happening right now. I mean, if you have that kind of conviction about a property, that look, there's something that you know that not everybody knows. Like maybe they're building something right next door, right? Maybe Google is building a big office right next door. Maybe you know something, then maybe it's worth it to go into those negative leverages and all that. But otherwise, stay with positive leverage. So let's say if your interest rate, a long-term interest rate is 5%, try to pay 5% or more. I know it's hard, but that is how you should be investing in it. And do not compromise on location and the tenant quality, and I think that will serve well. But if you are developing, again, just pay attention to where people are going. Try to fill in a need. And senior housing is great. I'm not talking about assisted living, but we have so many old people coming our way. The baby boomers, they're retiring by rows and rows. And as soon as this interest rate situation settles down and all that, a lot of these people will be selling their homes and they'll be looking for places, senior living, 55 plus, independent living, right? We call them 55 plus, but everybody who tells me about them, I think the average age people who are living there is like 70. They cannot afford to live in assisted living and pay $5,000 rent. Rather, they pay 10-20% more rent and live in these 55 plus communities as a community, and they get some additional help. I myself is looking into that space. So you always look for what's next. Car washes, that's picking up a lot of momentum. Why? Because Ola, you and me, we won't be paying any subscriptions for car wash. When we need a car wash, we're going to get a car wash and that's it. We're not going to pay 30, 40, 50 months a month. Why would we do that? But people who are born in 90s and 2000s, they got used to this subscription. They'll pay that 40, 50 bucks model, and that's what they're doing. And now car washes are looking like dealerships now. They're serving beer inside as you wait for your car to get detailed and all that, right? So now when you have subscription model, rain or shine, you're going to bring in a lot of revenue, right? On a recurrent basis. When you have a recurrent revenue model, you can put a cap on, right? And you can it'll become a proper commercial property, which you can just consolidate and sell as a portfolio, right? So a lot of that is happening. So my eyes on that. So that is what I would say. Somebody who's getting started, do not compromise on location, and do not go into inverse, like negative cap rate at all. That's just recipe for disaster. You won't be alive for very long. Look where the margin is and what's the next. That is what it is.
Awesome. Wow. Oh, wow. You brought a ton of information to my show today. Honestly, I would say, what can I say? We could go on and on and on and on, but thank you, Venkat, for what you've brought on the show today. You brought valuable experience, thought leadership in the space of income producing property, particularly value add property in apartments, and also to development in apartments. And obviously, how do people get across to you if they, what do you want to say to my audience in terms of your firm?
They can visit our website at Stryker Properties, STRYKER properties.com. Or they can write me an email at Venkat, VENKAT, at StrykerProp, STRYKERPROP.com. So that's the best way to learn about our company and reach out.
Awesome. Like you rightly said, they're online. You can join. You can visit them online also to their portals that are valuable things to share, and you can visit them. And Venkat, as rightly said, it is accessible also to great man. It's done it, been through the 9 yards, still in the game, still in the game, awesome. Valuable experience we've had with you today, valuable nuggets you brought on here, thought leadership from your side. We would be glad to have you some other time also to going deeper into the space of apartment investment. Once again, here on Commercial Property Club, we've always said we'll bring you valuable experience, thought leadership in the aspect of income producing property. Today was another day of vast information that really, I hope, has been helpful to you guys out there. Thank you for joining me here on Commercial Property Club. It's going to be another day when I bring up another guest. Thank you, Venkat. Thank you for coming on my show today. Thank you so much. Good to see you. Enjoy the rest of your day, sir. Okay? Thank you. All right. Take care. Bye.